You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back. That means it is Education Wednesday on the network here once again. That means it's time for the premier options education program known around the globe as Options Bootcamp, even though the cool kids call it OBC. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the aforementioned network. I want to thank all of you out there who take time out of your busy day, not just to listen, but also to rate and review wherever you find this content. Obviously, this show's been running for a while, over a decade, but clearly new reviews do translate well into the algorithm, help new people continue to discover the show. So if you've been listening to it for a long time, never left a review for whatever reason, or you're one of our legion of new listeners, we see you folks coming in all the time. Make sure if you do like what you hear, if you don't, send the hate mail to Dan. If you do like what you hear, leave us a nice review on your platform of choice. Again, it does help new people continue to discover the show. And of course, if you want to discover more content, man, we got a double palooza coming at you today, listeners. All of our pro members, of course, tune in live right now. We got a great double palooza of Options Bootcamp coming at you. And then pretty much immediately after these shows, we're going to be joined by the once and future and now present Dr. Vic, Mr. Russell Rhodes, for another great pro Q&A session answering all of your questions about volatility. So if you folks have questions, and chances are, given these markets, you probably do, then theoptionsinsider.com/pro is the place to go to get all those questions answered and much more. We have nearly 200 episodes already up there on that feed exclusively for you. So chances are your questions already been answered. You could listen to that feed nonstop for over a week. No eating, no going to the bathroom, just nonstop listening 24/7. So there's a lot of great questions that have been answered already up there. And of course, you also get live access to this, everything else we do. And the giveaways are coming up soon. It's going to be the March Pro Trading Crate giveaway. So a lot of fun to be had over there. Check it out for yourselves, theoptionsinsider.com/pro. As I check out who's joining me for this awesome, epic Options Bootcamp doubleheader. First off, I say first because we got double guests to join us on the doubleheader. First off, you know him, you love him, some loathe him. That's the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the old Options Bootcamp drill instructor proving ground, sir.
Well, hello, Mark. It is great to be back here on our show.
How are things in the options mecca of Frankfurt?
They are fantastic, man. Here in the outskirts of the Windy City, it is starting to get a little bit warmer. So that's a good thing. It's been a rough winter. The older I get, the more I don't like these winters. And, I'm ready to talk some options.
Yeah, but joining us to talk those options, who better than the options guy himself, Mr. Brian Overby. You know him, you love him from Options Playbook Radio. He's slubbing it today over here on Options Bootcamp. Mr. Overby, welcome to Options Bootcamp, sir. I'm not sure if you've ever had you on this show before.
I'm not 100% sure either. It's been a long time running, so I'm pretty sure at some point in time, either I dreamt I was on the show or I was on it virtually. I don't know exactly, but I want to invite Dan down to Charlotte. If he ever wants to come down and get rid of that weather, it'd be kind of fun to come on down to Lake Wiley in Charlotte, North Carolina, and enjoy the nice weather. We got the spring coming. It's been beautiful, Dan.
Oh, yeah, man. North Carolina, it is nice down there. I got to give you that, my man.
I don't know. Can Charlotte handle two options guys within its proximity? There may be too much options for the Charlotte area. I don't know.
It might be like a polar opposite thing going on down here. But no, it's wonderful. It's great to be on the show. And I love when we answer some listener questions.
All right, so let's get to that. We got this one kind of inspired by some questions, and of course, inspired by Mr. Overby's appearance. Let's get into a little bit of the old basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, print bear to learn. Yes, sir.
All right, everybody. Welcome to the basic training, the portion of the show where we take a basic options concept or technique or strategy and explore it in a little bit more detail, explain how you can utilize it in your portfolio. Today, we're going to turn it up a notch. It's not quite a basic strategy. It has a little bit more nuance to it, multi-leg, so maybe more of a 201, not quite a 301. I'd kind of reserve, let's say, time spreads and things like that for the 301, but we're kind of flirting with 201 territory here, listeners. So let's get to it. What are we talking about? Well, Mr. Overby is joining us, and you know if you listen to OPR that the man loves himself a fly, in particular, some skip strike / broken wing flies. So let's get to that. Before we even do that, in preparation for your appearance, Mr. Bryan, we put the question out to our audience because, at the end of the day, our audience, they are the arbiters of all things on the network here. So we asked them this question. We said, inspired by this week's Options Bootcamp, how do you prefer to trade your butterflies? Are you more of a traditional fly trader? So your traditionally symmetrical fly listeners, let's say you buy it on one at the money strike and you go out 5 strikes for the short 2, and then you go out 5 more for the long 1. Is that how you like to set up your flies in the traditional symmetrical method? Or are you more of a broken wing, or as Brian calls them, a skip strike type of fly? You like to set them up in your own custom configuration? Or is it more dependent on the situation? Brian, as our guest, I'll let you go first. What is your vote, even though I think I know what you're going to say? And then B, more importantly, what do you think our audience is saying, sir?
Well, yeah. Well, obviously, it depends a little bit on the situation, but I lean towards bringing in a credit as opposed to always paying a debit. So the broken wing or the skip strike is the ideal. So I guess that's where my vote would be, even though, you still got to have a little bit of volatility if you're doing a skip strike. So it does depend on what's the volatility of the underlying, because it's hard to get them done for a nice net credit to the account if you don't have a little bit of volatility behind it.
Interesting. Mr. Dan, same question for you, sir. Which way are you going, and which way do you think our audience is going?
Well, I have studied these for a number of years and actually just did a really big deep dive study on how professionals trade wing spreads in general. And I found that, well, like Eric said, it is very, very situational. There is definitely a time and a place for everything. But much of the time, I won't even say most of the time, but I'll say much of the time, I think there's a better way to trade a butterfly than skip strike. You end up with sort of this weird Frankenstein monster where it has to do this, but not too much of this, but not enough of this. And it's just kind of weird. And so I think the traditional ones end up performing better in the long run.
Interesting. A little bit of divergent opinion. That's what makes a fun show, listeners. Speaking of divergent opinion, this has only been live for a few minutes, listen. Just went live right before showtime. This will be our question of the week, so you guys can play along. At Options is the place to go to make your voice heard. But our audience also evenly split right now, pretty much exactly 50% each for the traditional / old school fly versus the broken wing / skip strike fly. No votes yet for the situationally dependent. That was kind of our cheap little out for you folks if you couldn't make up your mind. But everyone choosing this week, which is good to see. Ad Options the place to go to make your voice heard. All right, let's get into it. Again, we have a lot of new listeners all the time. It's been a little bit since we dove into the old spreads with wings. So let's start with a bit of a refresher. The butterfly. What is it? Why is everyone so fascinated with this strategy? Why is it growing in popularity right now because of all the 0-day fun, all that goodness? We're going to get to it, listeners. Let's start out basic overview. Everyone's favorite, XYZ. Trading for $50 right now. You think maybe over the next month you're going to see a little bit of upside in XYZ. And so you look at the options chain. You say, what can I do from an options perspective out here in XYZ? And you see that front month at the money, that 50 call, trading for $3 in our example. You say, I could buy that. Obviously, anything above $53 you will participate in. 53 being that cutoff because you spent $3 for that call. Of course, if the stock just hangs out around $50 for the next month or drops, you're going to be out that $3. So you can multiply it by the rest of the year. You can see if you keep doing this approach, that can get pretty expensive fairly quickly. So you say to yourself, what can I do to perhaps reduce that outlay and make my life a little bit easier going forward? And that's where you look at some of the other strikes that are going up out there. So in our example, we'll make it nice and smooth. How's that, listener? So it's not confusing at all. And in this example now, you've got the 55 strike call trading for $1.50. So you look at that and you say, wait a minute, I could buy the at the money call for $3, the 50 strike call, and then sell 2 of the 55 calls for $1.50. Guess what? I've scratched my outlay because I sold 2 for $1.50. 2 times 1.5 is 3. Paid 3, collected 3. I'm flat. And yes, you are from a premium perspective, but of course, we've always said many times on this show, listeners, don't be naked short units to the upside. Don't be net short units. Not a way you want to live. We've all seen what's happened over the last few years. Short squeezes. Stocks can explode to the upside. In this strategy, you would have infinite risk above the 55 strike. Not a thing we really want to recommend here. So you could come back in this scenario and say, well, I want to cap my risk at the 60 strike. And in our example, that's trading for 50 cents. So now you could buy that for 50 cents. So what have you done? You bought 1 call at the 50 strike for $3. You sold 2 at the 55 strike for $1.50. So you're flat from an outlay perspective. And you bought 1 more call at the 60 strike for 50 cents. So first off the bat, you've reduced your initial outlay from $3 in our example to 50 cents. So that's obviously attractive. You've saved $2.50 in this example. They won't always be this generous, shall we say, but it's a fun example to work with. My outlay is not 50 cents. That's your net risk for this trade. You can only lose 50 cents. If it explodes north of 60 in this example, you're only going to be out that 50 cents there at the end of the day. And you stand to make $4.50 because it's a $5 wide fly. It's a symmetrical, traditional, old school, call it what you will, type of fly. So you can see why these types of strategies are attractive, especially for underlyings that have expensive calls or expensive puts, whichever direction you want to go, and you just maybe don't want to shell out all that money for it. It's attractive out there. Now, we can play with that in a lot of different ways, and that's where we get to what we call here the skip strike fly. So let's do a quick example of that really as well. Maybe in our example, you come in and you buy that 50 strike call, and you say, I think this thing might actually have a chance to run a little bit. And now instead of selling the 55 call, you go all the way up to the 60 call. You sell 2 of those. So now you collected $1 because you sold 50-cent options twice. So your net outlay is now down to $2, but also you have all that room to run from 50 to 60. So you spent $2. It's a potentially $10 wide fly at the end of the day. Now you're going to go out and buy an extra call against that. Obviously, in our example, the 65 strike call is trading for 15 cents. So you spent net $2.15 on this whole outlay. So you can net make $7.85 on this bad boy if you get max profit. So obviously a lot more potential profit. You can lose $2.15, so you can lose a little more. But if you're a little bit more confident, you're a little bit more expectant of a bigger move, or maybe you want to play with those credits a little bit, then the skip strike or the broken wing is an interesting upgrade for you. Brian, we'll go to you because I'm trying to think in the history of all the episodes of OPR you've done, I don't think you've ever done a traditional fly. I think they've all been your skip strike methodology. So let's start there. Why do you prefer this so much? And then B, how do you normally like to set them up versus a traditional fly, sir?
All right. So when lot of the times when we're doing trades on OPR, we do things around earnings, probably more so than I would in my own trading, because we want to set things up based off of what the marketplace is telling us. For example, Amazon always would announce earnings on Thursdays. For many years, they always announce on Thursdays. So you have that 0 DTE option contract on Friday. It's got one day to live. And when you're doing something that has high volatility and you're doing like a skip strike fly, that's where the situational thing comes in, because you need all that premium to come out. So that's part of the reason why I've done a lot of skip strike flies around earnings, just to try to get a little different and try to talk about, well, if this is the situation, this is the way I might approach it. Done a lot of traditional butterflies, but those are usually centered around the SPX, not an individual stock. So that goes back to basically the way that I answered the question that you proposed today, is that it's in a scenario where I could have a decent volatility crunch, or I have very short term expiration. That's usually when I will look at doing something like a skip strike fly. And I like to call it that skip strike because we are skipping that strike. It's better than the broken wing, which, I've heard that term many times, but in the options playbook, I called it the skip strike because we're skipping that 60 strike call. So in my mind, I'm not necessarily a butterfly trader. What I really am, when I skip that strike, I embed a short call spread into the butterfly that pays for it. So one way that you could think of this, because I just like to explain things as many ways as possible. And if I'm a short, let's say we're on the call side, like you're using in your example here, but if I was thinking about doing just a short call spread, an alternative is the skip strike butterfly, because by doing it, I'm embedding a hedge into my short call spread. Now, the biggest thing is that I need some volatility to be able to do that. So I need some volatility with some predictability, which is a little bit of an oxymoron. I don't want to do it on extremely volatile stocks, even though I've talked about it around earnings and stuff like that, mainly just because of the situation. But ideally, I want to have a little bit of predictability with a little bit of volatility, and then I will think about the skip strike butterfly as an alternative to just selling the short call spread or the short put spread, because I'm already putting a hedge in. And by doing that, if the market does come my way, and it comes the wrong direction, I should say, goes either towards my short call strike or my short put strike, you don't get rewarded right away for the trade. Usually, it doesn't really start helping you out until a little closer to expiration. I think that's a little something that Dan was hinting at, is it's very schizophrenic as far as where exactly you want the market to go. But if you're thinking that, oh, by the way, you take the concept that you're going to do a short call spread, and I want to bring in premium, I don't want to pay for this trade. That's another way to approach the broken wing or the skip strike butterfly. And I like to use it a lot when I'm thinking about short call spread, as opposed to, so I guess the moral to my story would be that if I'm considering a short call spread or a short put spread, I want to think about a skip strike butterfly, if the math works.
That's why I said these are more of a 201 type strategy, listeners, because there's a lot of moving parts involved here, and you could think of them many different ways. The way Brian was just laying down here, we were just talking with Matt Amberson on the Advisors option yesterday about this exact topic, butterflies there as well. He said he likes to think of them more of using them as a long vertical spread, and then if things go your way, maybe you want to stay away from pattern day trading, you could sell another call spread against it and leg into the butterfly that way. So there's a lot of different momentum ways to leg into or take off butterflies, which are intriguing as well. Mr. Dan, over to you now, sir. Same question for you. I've always said butterflies are almost like religion in the options world. Everyone has a little bit of a different take on them. Everyone does them in a little bit different way. They set them up differently. They take them off differently. So it kind of depends what type of trader you are, your viewpoint on flies, and how you like to use them. Sounds like you lean more in the traditional camp versus the skip strike camp. So please elaborate on that for our listeners. Why do you prefer one over the other? And then what are your thoughts in general about the skip strike or the broken wing, and how would you set those up if you were going to go about it?
Right. I'm actually, I am actually doing free online training at 3:30 today, Central Time. So what is that? Like 2 hours away from now. All on wing spreads in general. And one of the things I talk about is the risk. And although I don't delve into this part of it during the training, when we look at stock prices, we want to put as many things on our side as possible whenever we're making any option trade based on that, right? And the disproportionate risk reward, the disproportionate loss can a lot of the times be just kind of weird when it comes to the broken wing butterfly. That said, I'm going to double down on that. There is a time and a place for everything. In fact, we have a scanner that scans for wing spreads, and there was one that came up there yesterday in a little stock called SLG. What was the name of that company again? SLG. But they are a REIT. And they actually pay a really, really well. Actually, before I get into that, there was a broken wing butterfly that came up. And I was looking at it, I was like, why is this popping up on our scanner? Because it only pops up if a professional trader has traded it. Right, which kind of gives us a head start in it being a potentially high probability trade, right? So I was like, okay, so somebody traded this pretty big. Why is somebody doing that? Like, it doesn't make sense. Like, they want the stock to go down, but if it goes down too much, they lose a bunch, and they added that extra risk to the downside, and the upside, they just lose a little bit. Is like, this doesn't make sense. I don't get it. But then I looked really closely at it. And I realized that they have a pretty high dividend payout. And if somebody owned that stock along with the broken wing butterfly on a 1-by-1 by 2-by-1 ratio, like 100 shares by, one lot spread, it ended up being just a brilliant trade. So, there's a time and a place for everything. But me just knowing, having done this for a while, knowing, hey, sometimes you make money on your trades, sometimes you lose money on your trades. I always want to sort of balance out the risk and have the best risk reward I can get. And, it's my observation that I get that more often than not with a straight butterfly. But it's never a bad idea to, if you're considering a straight butterfly, to look at the broken wing version, look at wider wings, look at tighter wings, look at longer expirations, shorter expirations, and pick the one that gives you the best risk reward for what you're trying to accomplish.
Well said, sir. So there's your overview of your basic fly versus your skip strike or broken wing. And I kind of agree with you, Brian. Broken wing, skip strike sounds a little bit more positive, a little bit more uplifting. Broken wing sounds like there's something wrong with your strategy at the end of the day. But your traditional fly, listeners, is going to be usually symmetrical. You're going to put it on. Usually it's a long premium trade, buying one, selling two, buying one more farther out of the money. You traditionally want your underlying to move to that short strike and sit there so you can get the max profit out of that fly. But the more nuanced, the skip strike, broken wing, call them what you will, types of flies can be set up in a variety of ways and for a variety of reasons. You just heard Brian and Dan lay out their thoughts on that exact thing. Sometimes you might look at the strike chain and say, wow, these options are really starting to get bid up. This was very common in the days of 2021 and the meme stock palooza. We saw the call wings on a lot of names really just get bid to high heaven in levels that we don't traditionally see in a lot of equities. So there was a lot of times where you wanted to maybe adjust your flies to take maximum advantage okay, this strike is really bid up versus everything else. You may, for example, see there's a ton of open interest on one particular strike that's maybe a little bit farther out of the money than you normally would go, but because you could sell that strike because it's been bid up, you maybe want to adjust your strike that way. So that would give you an incentive to move those guts, move that broken wing or the skip the strike to get to there. There's a lot of reasons why you might want to go down this road. Listeners, inertia is another reason. You have an underlying spread, maybe a vertical you already put on, and now you're going to leg into this type of fly. A lot of ways you may want to go about this broken wing type strategy. But at the end of the day, it's another thing to consider if you're thinking about butterflies. Brian, I'll leave the last word on all things broken wing to you this week because we have to get ready for the second part of our doubleheader here. But you are the guy, the keeper of the skip strike butterfly. Tell our listeners why they should be intrigued by this strategy and why it's something they may want to consider versus your traditional flies.
Well, you want to have something that's in your arsenal that's appropriate for when the pricing is saying that, hey, by the way, I'm thinking of the short call spread. I might be a little bit more bearish on that underlying stock. So I was going to do a short call spread anyways. Maybe I'll do a skip strike. If I can bring in a big enough credit from doing the skip strike, I have a built-in hedge. That is probably the best opportunity to do it. And even like nowadays with the VIX right around the 20% level and the fact that that is now the new low volatility, right? I used to consider low volatility around 12 or 13% in the VIX, but at around 20%, they're even interesting in indexes like the S&P 500 index or the SPYs because you have a little bit more volatility when you're looking at those trades. So that's my rationale behind when and where I would like to look at a skip strike. And I think it's important to tie it into a simple strategy like a short call spread or a short put spread.
All right, we'll have to leave it there for this week. Pro listeners, never fear. We'll be back instantaneously after this with another episode answering all of your many and varied questions. You guys have a lot of questions you want to get at Brian and Dan with. We'll have the answers coming up post-haste, all you on-demand folks. This will be hitting the network the week after whenever this one hits. We got a whole bunch queued up coming at you. So a week after, you'll be hearing this episode. But before we go, let's go around the horn. Mr. P, we'll start with you, sir. Folks want to check out your Spreads with Wings training or maybe go on a little retreat with you. Where should they go? What should they do?
Yes. Well, folks, if you want to register, if you trade butterflies or condors or the iron versions or the broken wing versions, whatever it is, and you want to learn more and you want to specifically learn about this brand new tool that we developed, go to markettaker.com/REG as in register, REG, market as in stock market, taker as in take what is rightfully yours, 2 T's in a row. The second T is for theta. So markettaker.com/REG and register, and I'll see you in a couple hours.
There you go. Don't forget the second T for theta. And Mr. Overby, I know you're cooking up a few cool new things over there in Options Guyland. In the meantime, let's say folks, they want to follow you on the old social medias. Where should they go? What should they do?
Yeah, Twitter's the best way. I'll let you know exactly what's going on with everything educational-wise for the Options Playbook and also for the Options Guy. So just follow me on Twitter. My handle is very simple. It's my name, Brian Overby.
There you go, Brian Overby, Overby, all one word over there on the old Twitter is the place to find him as we keep on rolling, listeners, right on into our next episode of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's MIXLR.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.